Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, Indian markets have shown some correction this year after a spectacular post-pandemic rally. Now, one of the reasons for this correction is exit of FIIs with the rise in the interest rates in the US. While the exit of FIIs that fall under the category of institutional investors is making all the headlines, in today's video, I am going to share the names of some of the stocks where fundamentals look strong, the earnings have improved despite all the turbulence at the macro level, and most importantly, where the overall institutional stake, including that of FIIs in some cases, has gone up. So let's dive in. First things first. What is the significance of presence of institutional investors in a stock? Well, institutional investors deal in huge amounts of money and come with experience and are considered savvier than an average retail investor. The category of investors includes venture capital, mutual funds, alternate investment funds, pension funds, insurance companies, and FIIs. They have access to managements unlike retail investors and are likely to have better insights about the industry and the companies. It is for this reason that the money they bring in is called smart money. When they buy or sell a stock, the positions they take are huge due to the sheer amount of money that they manage. This could lead to sharp swings in the price of the stocks. When they buy stakes, the stocks could get re-rated or increase in the stock price, and when they sell stakes, the price could witness sharp correction leading to derating. The trend of institutional stake in a stock is especially interesting to track when the market sentiments are uncertain or weak. During these times, these investors, just like others, move with caution. If they increase their stake or buy a particular stock, it will be a reflection of confidence in a particular business or management. A stock with higher institutional ownership is also considered to have better corporate governance due to the kind of scrutiny it is under. The downside of large institutional holding could be a sharp correction in the stock when the institutional investors decide to dump the stock. Just like other tools that I have shared in my past videos, this is a trend that should not be used in isolation. This is just a screening tool, a starting point. So when you look at the trend of institutional stakes, you also need to keep a tab on other parameters such as fundamentals and valuations for the stock and the business. It further helps to know what the biggest insider, that is the promoter, is doing with the stock. So I recently did this exercise and came across some names that I am keeping in my watch list. Now these are the stocks where the institutional holdings in the latest quarter is higher than a year ago and on a sequential or quarter-on-quarter basis as well. For this exercise, I have considered stocks that have a market cap of less than 10 billion rupees. Because this is a category where the re-rating potential can be the highest with the entry of big investors. I have considered stocks that are not just being lapped up by the institutions, but where the promoter's stake remains high as well. And I have narrowed the results to stocks where the share price has either witnessed a sharp correction amidst the recent volatility or where the valuations on a PE basis do not look exorbitant. I further weeded out stocks with high debt to equity ratio and with promoter pledging. So moving on to the list, the first stock on the list is Naha Polyfilms. It belongs to the same group as Monte Carlo, a group known for Oswald wool brand. The company makes BOPP films which are used in flexible packaging in both domestic and international markets. The positives in the company are expected improvement in the operational efficiencies backed by the increase in the scale of operations and better realizations with increasing contribution from value-added products. The stock is down 33% from its 52-week high and trading at a PE of 10 times. The stock has witnessed an increase in stake both from FIIs and promoters on a sequential and on a year-on-year basis. The second candidate is PIX Transmissions. It's the leading manufacturer of belts and related mechanical power transmission products in India. Its products find applications in diverse industries such as auto, agriculture, cold storage, food processing, oil and gas, manufacturing sector, among others. The key raw material is rubber. The stock has witnessed buying from the FIs in the latest June quarter, and both institutional and promoter stakes in the company have increased on a sequential and on a year-on-year basis. The third and the last on the list is RPG Life Sciences. The company manufactures APIs under categories such as immunosuppressants, antipsychotic, antihelminthics, and anticonvulsants, amongst others. It is also into formulations across 10 different therapeutic areas. Domestic and international formulations account for 65% and 17% of the revenues, and the rest of the contribution is from APIs. The company has witnessed growth higher than the industry rate. The balance sheet is debt-free and the contribution from new products stands at a healthy 19%. The stock is down over 20% from the 52-week high. It is trading at a PE of 19 times and it has witnessed a rise in both FII and promoter stake in the June quarter. The company has also reported a consistent growth in the operating profits over last 5 years. I would strongly recommend you to not treat these as stock recommendations, but do include them in your watch list for further study. With this, I've come to the end of the video. If you liked the information, do press the like button, share the video and your comments. For more such video alerts and updates, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.